We use something called RPRP grid. This is Revere Positional Risk Parity. And we have an internal measure for every ticker that combines the beta and the average true range. Our portfolios, when they're fully invested, run 8 to 12 individual names. Depending on what their score is based on beta and ATR, this is where they fall into this group. And this is the maximum position sizing that you can take and also smooth your risk across every name that we take. So this is how we smooth the risk, is by position sizing and measuring the volatility and the beta of each individual name. We've talked forever about how we allocate 50% of the portfolio to the indexes, primarily the S&P 500. That's our core positioning. And the reason for that is to handle the vicious rotation that you see at times in the market. And it's been very vicious this week. Money moving out of these growth names and into value names. And with RPRP to not get overly big in position size. For example, a lot of these names on their Revere volatility factor are in the high 3 to the 4 range. This limits our overall position size from 2.5% to 3.5% on these. And that's how we maintain the best position size, is one that you can not get scared out of. For us, that's on the smaller side because they're volatile. What's the difference between having a 20% position in one name or having 6 names with 3% sizes? It's the same overall portfolio. I know the typical CanSlim rule is to really get into just a few names and create 20 to 25% position sizes. We're just not going to do that at Revere. We promise a smooth equity curve as part of what we deliver to clients.
And this is our proprietary own rules. So say you have a stock that moves 3% a day. The average true range, the range is 3% a day. And you have a 6% stop loss. I'm using that figuratively because we don't use hard stops because the market makers know where they are and they rape retail investors all the time. So we get alerts and then we go sell. But say you have a 6% stop on a stock that moves 3% a day, 2 down days in a row and you're out and you're getting whipsaw. So if you've got a stock that's got an average true range, 3 or 4%, you may need a 12% stop loss underneath that stock, but then you would make the position size a lot smaller.
Marvell, 12.2. QBTS, that's a quantum stock, 10%. NBIS, 11%. These are significantly higher than the beta.
We would have a little smaller position size starting at the top with Marvell and NBIS, and then when you get down to the bottom, you could have a larger position size.
20 basis points of a loss is the max we want to lose on any one individual position. And we also want to do offensive selling in these names when they get stretched to the upside, because with this double-digit or high single-digit volatility, your profits can evaporate in a day or two.